Everyone, Ben Nelson here. Hope you're having a fantastic day. Time to check in again on the real estate market. And I missed last week because I was out hanging out with my family, having some fun and doing some camping. So I apologize, but I also don't because I enjoy family time. So I want to get updated and consistent content out, but I also need time with my family. So I know you understand that. We're going to jump into this today. This is going to be a pretty brief one because I'm just going to touch on a couple quick things. And then I'm going to be doing my full longer market update here in the next week or so. So be looking out for that. But just a couple things I wanted to touch on. And as I share my screen here. So this is what we're looking at we're in a really interesting place in the market because affordability was already an issue, and that was before interest rates started going up. And now interest rates are obviously, much, much higher than they were. 30-year fixed. This is just a Google search on mortgage rates. So ballpark, 30-year conventional fixed, almost 8%. I didn't even know it was quite that high, but that's getting up there, right? And then there are some other loan options than this that we'll get into here in a second, but 30-year FHA fixed just under 7.5%. So wow, huge difference from where we were this spring. We all know that. But then you look at and then you see obviously these articles coming out, lots of these kind of articles where builders and economists and everybody were warning of home price pullback, and it makes sense because affordability can only take so much, right? So if people can only pay so much for a house based on how much they can borrow and based on what that monthly payment is compared to their income and what they can afford. So totally 100% makes sense why there could be some pullback. However, you also have this other dynamic that there's a massive housing shortage across the U.S. And we talk about that a lot on these, that you have a huge supply and demand issue. So now we have these two opposite forces that are pulling at each other, where we have affordability as a huge issue. People cannot afford to buy at today's prices and interest rates, but we still need a lot of houses, and builders are pulling back and being more cautious in building because of the affordability issues. So how is this going to play out? I don't know. All I know is that, there is a breaking point with interest rates and affordability where people just can't buy or won't buy at all anymore. Until prices come down. At the same time, you have the other side of it where there's just a huge imbalance of supply, very short on supply in a lot of markets. And keep in mind that so overall supply is how many we need versus how many we actually have. But then markets are, when you look at the data, as far as a number of months of inventory on the market, within each market, that's based on absorption at the time. So if less buyers are out there could be the same number of houses on the market, but there were less closings last month. So now inventory goes up based on absorption. Hopefully that makes sense. So it doesn't necessarily have to do with how many houses are coming out on the market or how many houses are needed. When you're looking at some of those numbers, it has to do with more how quickly are they being bought up? So, but we still need them. We still need more housing units. And really ultimately what this comes down to is these rates are not going to be here forever. It may hurt for a little while. It may be, where we have a little bit of pain for a little while because we just have these interest rates as they're trying to fight and battle inflation. But at some point, people aren't selling right now because they're locked in on their fixed interest rates. So if they were planning on moving up, then they are maybe waiting because it doesn't make sense to do that anymore. Why would you get rid of your 3.5% or less? Some of them are in the twos. Why would you give up that interest rate to go buy something at 7%? You're not going to be able to buy, even trade across, right? Because prices really haven't come down. That's a general statement, but they haven't really come down that much, at least at this point. So you're not really going to be able to trade and have it make sense. So people are waiting. They're not going to sell. They're not going to trade up. They're not going to do that. And that's just going to keep. And then you got builders that are not building as aggressively. So that's going to just continue to stifle the market and keep inventory that we need out of the market. And so what's going to happen when the interest rates do eventually come back down, whether that's next year or the year after, is even if prices come down a little bit in the meantime, that demand is still there. It's like a big dam blocking, a river, right? And eventually that dam is going to break, and all of that pent up energy is going to be there still. And it's just going to be, back to where we were, in the last couple of years, where there's just this huge run on the market. That's how I see it playing out, is that maybe over the next year or two, it's going to be a little rough. It's going to be a little bit slower. Maybe prices will pull back a little bit, but then eventually and I don't know that we're going to get back to 3%, but eventually when we get back down a little bit more to earth on interest rates and something more reasonable, then I think the floodgates are going to open, and we're going to be off and running again. So I don't know when that's going to be, but that's how I see it. And we're going to have another run up. So now is actually, I think, a really good time to get in, because there's less competition. There's less people that you're vying against a property for, though depending on what you're buying, we're still seeing some multiple offers in certain situations. But in general, you have less competition. You have a good ability to go in and negotiate something with a seller and get some good terms and get a good price. And yes, you have to pay a higher interest rate for now, but when they come back down, you can refinance and you're going to get in. Again, timing the market is just a fool's errand. So if you're going to wait for prices to pull back and then buy then, and then, and you're never going to have a perfect storm either. You're never going to be, prices are at the bottom and interest rates are at the lowest, right? That just doesn't happen. There's not a perfect real estate market. So buy now, make it make sense now. If the market does pull back a little bit, it's fine, because you bought based on what works now, and then you're ready to capture that next round of appreciation when that comes back around. So that's my take on it. I thought what I thought was interesting, and this will get it a little bit into some tools to use as you're thinking through this. You don't have, so in the last 10 years, buyers didn't have to think about anything other than, man, I have a 3% interest rate. I'm just going to just get a conventional loan, right? Or an FHA or whatever. You're just getting a standard loan, right? So you don't really have to think outside the box at all. It was just get a loan. That's it. So now, and finally, I think buyers are starting to understand, and I'll show you why I think that here, because there are ways we haven't had to deal with seller credits or interest rate buy downs or any of that stuff over the last decade. So now we've got to relearn that, we don't have to accept this interest rate, right? Sellers are negotiable. They want to sell their product. They're willing to listen. So ask for some closing costs. Ask for the seller to help. Hey, I can't buy this property with today's interest rates, but if you help me get down to a different interest rate, then I can afford it, right? And you ask the seller for 5 or 10 or 15 or whatever the market bears, $1,000 towards your closing costs to buy down your interest rate. Now, some loans are limited in how much can be contributed, but depending on the loan, 3% is pretty common. There are some loans that allow 5 or 6% seller paid concessions that you can, now they have to agree to that, of course, but that you can use that to pay your closing costs and buy down your interest rate. And you can get your interest rate down significantly, get it down from the 7.5 range all the way back down to maybe even 5.5, 5%. So it costs a lot to do that. But if you can get the seller to get on board and say, hey, this is a way that I can buy your property, make it make sense for everybody. And so you don't have to accept this. And then there's ARM products, and there's some other things that you can do to get a more reasonable rate. So this is just one piece of the puzzle. This is just the loans that we're so used to over the last decade, because that's what we've done. And we've never asked for closing costs. We've never done interest rate buy downs because you didn't have to. But now we do. And so now buyers are starting to understand that. Sellers are starting to understand that. They're offering that. And this is, I think, proof in my mind. This is just one, scenario, obviously, but I just checked Google Analytics. I am not an expert at all on how Google Analytics work. All I can do is compare one versus the other. So I looked up interest rate buy down to see what people were searching, and you can see the trend of interest rate buy down has just trended up and up and up. And I compared it just out of curiosity to, is the real estate market crashing? Because that's, you know, been kind of the headlines and what people's mindset has been. And the question people have been asking, and there's been little spikes there, right? But people are asking that less and less, and asking more and more about interest rate buy downs and things like that. So I think the market is understanding here's where we're at for a while. People in general are thinking, you know, maybe there's going to be some pullback, but we're not going to see a huge crash. And they're looking for some alternative ways to get into a house now and still make it be affordable. So that's, and what I thought was really interesting, I made sure to include this map in here, is that you look at the markets that, you know, the areas where people are searching this, and it's all of the, you know, more expensive markets. Totally makes sense, right? Because those are the markets that are more affected by higher interest rates. Is, you know, your higher priced markets, you know, in the Midwest, your $250,000 house, you know, it affects you for sure, but it affects you, the payment a lot less than in a market that the average price is, you know, $450,000, $500,000, $600,000. That payment is vastly different than it was, you know, at 3.5%, 4%. So I think this is a good sign that people that are starting to get their head in the space of, let's figure out solutions to still get into a home, because there's a housing shortage and rents are going to continue to trend up. People stop buying, they're going to keep renting. That's going to put more pressure on rents. And we're kind of plateaued a little bit in a lot of areas on rents. We're not going to see the huge, you know, 20, 25, 30% rent increase annually that we saw over the last, just like appreciation, right? But we are going to probably see some more upward pressure on rents, because if people are going to hold back on buying, then they have to rent. And, you know, as we said, there's a huge housing shortage, so supply and demand, right? I also wanted to touch really quick on, so I've heard a lot, and this is more in the multifamily commercial real estate space. I am curious how that is going to play out, because that could be a lot different than your single family home space, because your single family home, people always need a place to live, whether that's renting or buying. So they're going to figure out a way to do that. And we talked about a lot of that with interest rate buy downs. Let's think creatively. Let's make things happen and still move some product and make sure we have a place to live and buy. People don't have to invest, and people don't have to buy investment property. People love investment property. Lots of people love investment. I love investment property, but it's much less sentimental and a lot more based on the numbers and what do the numbers say makes sense to have returns. And I've heard over and over again the last couple of weeks from multiple clients and multiple conversations that, hey, I love this building, I want to buy this building, but the price that the seller is asking doesn't make sense with the debt that I am able to get on that property now. The cost of the debt is just beyond where that makes sense. I can't buy at a 4 or 4.5 cap. And if you don't know what a cap rate is, reach out. Happy to have that conversation with you. But yeah, I can't buy it at a 4, essentially a 4 to 4.5% return, cash return. If you're buying cash, you'd be making 4%. I can't leverage that with debt that I can get today at 6.5, 7.5%, and have it make sense. I'm paying more for the debt than what I'm getting in return. That doesn't make any sense. I can't do that. So that to me has a greater chance of maybe having some pullback, because investors are buying, unless they're going to be very speculative. You know, okay, I can take some more meager returns now, or I'll just put more cash into it now so I'm not negative every month, and I'll wait for interest rates to come back. I still think prices are going to appreciate and rents are going to go up. There definitely could be people buying, and are people buying with that mindset. But if you're not willing to speculate that much, if you want to buy based on what makes sense now, and then, you know, anything that happens down the road is icing on the cake, which is the more conservative approach, of course, then, you know, they're either not going to buy, or sellers are going to have to come to reality on the fact that their prices are going to have to come down relative to what debt is. So again, there's always cash buyers out there. There's always people willing to speculate. There's always people willing to maybe take a little bit of a loss now for for, or let the tax tail wag the dog, which I'm not a proponent of, but there's other reasons other than, just the returns, the upfront returns. But if you're buying, again, if you're buying based on, here's the return that it is right now, and here's my debt, it's got to make sense. Then pricing is going to have to change in the commercial and apartment space, because that's what people are looking at as the numbers. So that's kind of the buyer sentiment that I found in the multifamily and commercial spaces. I'm willing to buy. I want to buy. I like this building. I like this market, but I can't make it work at that price and these interest rates. So that's where we're at. Where are we going to go from here? Again, nobody knows for sure, but I feel like we're going to have a year or so where things are going to kind of have to work themselves out and shake themselves out between inflation and interest rates, and trying to get back on some sort of solid ground to kind of see where things are going. But I'm still optimistic. Things are still selling here in the Portland metro area where I work. And I know they are in other markets as well, that the drivers are there and that it makes sense to buy, or that people are needing to buy or moving in the area, right? We always want to look at what are the indicators, what is the market doing whenever we're buying. If we're buying as investors, you always want to look at what are the drivers of the economy, so that it can work its way through periods like this and be okay. So those markets are still doing well. Again, it's very niche, very specific. There are some, and it's not even price point specific necessarily. It's a little bit price point specific, but it's also product specific. Like I had a couple that were in the entry level price range that have sold pretty darn quickly, and then had some buyers that we're working with that are buying nightly rentals, that we looked at a couple that had multiple offers within less than a week, like 7 or 8, like not just 1 or 2. And then we have, some that this wasn't mine, but I had heard from someone else that, it was $1.5 million home, and it was dialed in and super nice and a great location. And it had multiple offers the first weekend. So we're still seeing it. We're still seeing that. We're still seeing that there's the demand there. It's just a matter of figuring out the affordability piece. So thanks for listening. Appreciate you watching these, and hopefully they've been insightful and helping you, see what's going on and hopefully see where things are going. Please subscribe to my channel if you haven't. Keep an eye out for my longer update. This actually went longer than I intended, but my more polished update, I guess I should say. Check out my podcast, very specific topics that we talk about in there. And hopefully the combination of that gets you what you need to get your mindset where it needs to be, to understand where things could be going, and to take action in whatever it is that you're trying to do, whether that's buying your own residence or doing real estate investing. Again, we don't want to sit on the sidelines. We want to go out there and take action. There's always deals out there. There's always deals that can be put together and solutions that can be created if you know how to do that and you're willing to do the work. So don't give up. Get out there, make things happen, buy real estate, hold it, and make some things happen. Thanks again for listening. Make it a great rest of the day.